Hey guys, welcome to another video. Thanks for joining me in this one. In this particular video, I'll be talking about the ARKX ETF. If you're new on my channel, my name is Stephen Ojo, and on this channel, we talk about aviation and finance. And if you're interested in any of those, kindly subscribe to the channel by hitting the subscribe button below. And also, if at any point you find value in this video, please don't forget to give it a thumbs up. Now, the reason why I've chosen to talk about ARKX ETF is very simple. I talk about aviation on my channel and money, so the two actually goes along. So I'll be sharing some of this information with you in this video, and my goal is to make this video not too long, okay? Because if it gets too long, it becomes boring. Most people won't stay to watch everything. Now, if you're new to investing, one of the questions you may be asking is, what is ETF? ETF stands for Exchange Traded Funds. And basically, this is a basket of companies that are sold as a unit. Just like the way you buy individual stocks on the market, the same way is how ETFs are traded. Now, the beautiful thing about ETFs is that they actually have a lot of benefits over a single stock. Just to make this clear to people that may be new to this, if you want to buy, say, Apple stocks, one of the things you want to do as a thorough investor is to seek the underlying conditions of the company you want to invest in. On one hand, that's good because that means you know exactly what you're investing in. And on the other hand, it takes a lot of work. With ETF, you have this basket of companies that are already selected by a pro. Generally, they're there to do the homework, which you may not have time to do. Most ETFs may have up to 10, maybe 50, maybe 100, or even 500 companies and more in one single ETF, which means if you have $100 and invested that $100 into that ETF, your $100 will be diversified amongst all these sub companies. Okay, now that is a beautiful thing because that means that your money is diversified, and if the companies do well, your money goes up in value, and if most of the companies do well and few companies do poorly, your money will still go up in value. On the other hand, if you have invested in single companies, that means that you would have to do a lot of research with all these companies. And if you go wrong with the companies you selected, your money goes down in value. Now, there are two types of ETFs. There's some that are passively managed and there's some that are actively managed. The passively managed are basically ETFs that track an index. So for example, the S&P 500. With actively managed funds, well, the goal of this manager, of the person that manages an actively managed fund, is to make sure that they continue to make sure that they prevent losses and hopefully make trades that are wise. Because remember, if the fund manager doesn't do well, especially in an actively managed fund, which is more expensive to invest in, what would eventually happen is that a fund manager gets kicked out. So in order for him to keep the job, he needs to make sure he continues to do his job thoroughly. Now, there are some pros and cons with these ETFs, okay? In general, okay, having an ETF means more diversification, which is good because that means that your investments are spread around on all these companies, and that means if one company goes bankrupt, you still have a chance for your ETF to survive and sometimes even profitable. Now, the other benefit of an ETF is the cost. If you think about this, if you hold, say, 100 companies, individual companies, okay, that means for each transaction you make, you would probably incur maybe some fees. Back in the time when we used to pay, commissions for each trade, but nowadays we don't have to do that anymore because, most of them are free. But at the same time, you still have to worry about your taxes on each of this company because you have to worry if you've held it for maybe a year or longer, or maybe you've held it for months, which means you have to worry about short-term capital gains tax or maybe even a long-term capital gains tax. And this consideration will have to be made on all of these companies. But with an ETF, well, the fund manager has to do all of that for you. Also, you don't have to worry about the cost of paying for maybe commissions on maybe 100 companies. You just have to worry about one, because if you make a trade on that ETF, that is just one transaction being made. And of course, one of the greatest benefits of an ETF is less research is needed. Like I already mentioned, 100 companies means 100 research and a lot of time spent to make sure that your money doesn't go into dust. On the other hand, with an ETF, well, you just need to research one ETF. If you like it, you invest in it and you're done with it. And occasionally you come back to check if things are going good. Now, some of the disadvantages of ETF is pretty straightforward. One of them is expense ratio. The fact that you have a fund manager working for you means that that fund manager needs to be paid. And of course, if it's an actively managed ETF, that means that they charge more. And if it's a passively managed ETF, that means they charge less. You need to always give consideration to costs because cost may seem a little, but over years of 10, 20, 30 years, maybe 40 years, this cost generally adds up. One of the cons that is so common about ETFs is that most of them may not actually be the market. When we say the market, we're talking about the stock market in general or the index in general, like the S&P 500, okay? For example, back in 2019, the stock market performed so well, and according to research, most of the actively managed funds didn't even come close to beating the market. Last but not least, and of course this is not even all, is over concentration in one sector. Now, some ETFs will try to track a particular sector, for example, a technological sector, or maybe the health industry or the health sector. Now, the problem with this is that means if the technology sector falls tomorrow, the whole portfolio, if you've invested in one ETF, goes down. So let's get to ARKX ETF, okay? This is a Space Exploration and Innovation ETF. The goal of this ETF, like I already mentioned, is long-term capital growth. Now, that means that the goal of the fund manager is to make sure that, they stay invested for at least a year or more in particular companies that they've selected. And of course, if things change during the course of a year, they might need to make a change to that ETF. But the expense ratio for this ETF is 0.75. And according to the prospectus of this ETF, at 0.75, that means for $10,000 invested, you would only be charged about $77 for the first year. By the third year, you will be paying about $240. And of course, this would increase as the number of years also increases. In my opinion, that is not too bad. But of course, if you're comparing this with like a Vanguard fund, that is very expensive. Now, some of the companies that are selected in this ETF include artificial intelligence companies, robotics companies, and 3D printing companies, materials and energy storage companies. In my opinion, I believe it's a decent ETF. It's a good one, but that doesn't mean that you shouldn't invest in it. And like I said, I am investing in it, but you just have to understand that the expense ratio is high and the companies that are selected in it are not necessarily, aviation or space related companies. Some of them are, but most of them aren't. In my opinion, when Cathie speaks, you want to listen. That doesn't mean you should do exactly what she says. But I have to be honest with you, Cathie often comes up with a lot of high expectations, and she's achieved a lot of the things that she said when it comes to investments. But for this particular one, with the companies that are listed, this ETF, they are pretty good companies. For a long-term investor, with someone that has a long-term approach, I believe this is a good ETF to invest in. But one thing that needs to be kept in mind is the fact that it takes a while for you to see the performance of this type of ETF. You might have to give it about 3 to 5 years to really see how this ETF is doing. Like I said, I am invested in it and I want to see exactly what it's going to do long term. But I'm not going to put all my money in this type of ETF just because, it's Cathie Wood. My thought for you, if you're thinking of investing in it, is of course you can invest in it, you can put some money into it, but don't be overly concentrated in this ETF. Now, one thing you need to keep in mind is that this ETF also has a lot of technology companies included in it, which means that if interest rates starts to go up, this ETF might see a dip. Well, I hope that you found some value in this video, and I hope that you've enjoyed some of the information that you've gotten from this video. If you have, please give it a thumbs up, and also if you want to subscribe to the channel, feel free to do so, and I'm going to see you in the next one.